Non-QM loans, what non-QM stands for is non-qualified mortgage. And qualified mortgages are the mortgages pretty much that everybody's heard about. Conventional, FHA, VA, those are considered qualified mortgages. Non-QM loans don't have to follow and abide by the same guidelines that those traditional loan types do. The most popular types of non-QM loans are bank statement only loans, DSCR, and then there's one that actually we just got access to, which is a no income primary loan. Whenever somebody's purchasing a condo, whether they're financing or paying cash, it's super important that they ask for the condo association's meeting minutes.
Absolutely.
So that you can at least see, hey, what's been in discussion. And that'll give you an idea of what's coming up.
What typically are the costs on a mortgage?
Really, it comes down to three main fees. Underwriting fee, the appraisal, and then there's credit report. Everything else typically, unless you're being charged points, are all third party. So title company, state and county, insurance, those types of things. When the Fed lowered their rate a few weeks ago, there was a lot of people putting out false information in the mortgage space saying, hey, mortgage rates dropped. What's funny about that is that ever since the Fed announced that they were lowering the rates, every single day since then, except for Friday and today, rates have gone up.
Welcome to Making Money with Laura Sanders, a name you can trust. With over 20 years of real estate experience and selling over 150 homes a year, Laura Sanders is the #1 RE/MAX agent in the state of Florida for 2021. Join us each week as we discuss how to make money through buying and flipping homes, to renting versus selling, and everything in between. To join the conversation, call in live 888-994-4995, Studio A.
Hi, everyone, and welcome to Making Money with Laura Sanders, and I am your host, Laura Sanders. Every week, we talk about something that will help you make a little money, save a little money, maybe just help you navigate the crazy world that we live in. Today, we're here with one of our awesome mortgage guys. His name is Max Fisch, and he is with Nationwide Mortgage, and he's going to tell us today about non-QM loans.
Non-QM loans, what non-QM stands for is non-qualified mortgage. And qualified mortgages are the mortgages pretty much that everybody's heard about. Conventional, FHA, VA, those are considered qualified mortgages. Non-QM loans don't have to follow and abide by the same guidelines that those traditional loan types do. And that's what makes them marketable, because they kind of can function in the gray area, if that makes sense. It's not as black and white. So what we do when we qualify somebody is we say, okay, there's tiers. Let's see if you qualify traditionally. If you don't, then there's a safety net, which is what non-QM loans are. And the most popular types of non-QM loans are bank statement only loans, which I'll go over. DSCR, which we've talked about a lot on the show.
Which I recommended somebody for you to call today for that DSCR.
Awesome.
Or
Yep. And so that's a super popular one. And then there's one that actually we just got access to, which is a no income primary loan, meaning you can buy a primary residence with no income verification. You don't have to have a job. You don't have to provide tax returns or pay stubs, which is, it sounds sketchy. It's like, oh, is 2008 going to happen?
What's their motivation behind that?
Yeah. So really the cool part, the way that this loan works is that, and you could be a first time home buyer, is that you need to have a 680 plus.
That's still not that great. Okay.
Yep. But you need to have 25% down.
Which isn't that much.
You need to have 9 months of mortgage payment in reserves.
That could be a problem for some people, but okay.
And the caveat is that the interest rates are typically higher.
And what are we looking at? Like
right now, you're looking in like the 8%, where normally you could get in the low 6s.
Okay, so about 2%.
But here's the cool part about the loan. The cool part is that there's no prepayment penalty. So I'll give you a real life example. I had a client come to me the other day, and they just became self-employed 6 months ago. Well,
so they're not showing income.
We don't have any tax returns. We don't have anything. So in the past, that person, either they would qualify for a DSCR if they were buying an investment. But
you're really not supposed to live in
Correct.
that.
But if they wanted to buy a primary, there would be no option for them. They would be at least a year or two out from being able to purchase anything as a primary residence. With this loan, what they were able to do is they had the 25% down. They had a 740 credit score. So now the way they're looking at it is, okay, I like this house. I want to get into this house. So they are able to purchase this house with a no income primary loan, which is what I'm talking about. And now they're going to get into a position next year or the following year to say, okay, now I have 2 years of tax returns.
Right.
And now I can qualify for a conventional. and I'm just going to refinance into a conventional because there's no prepayment penalty.
That's really good. Yeah.
So that's kind of, that would be what that program is for. But again, we want to see if you qualify traditionally. Then we go to the non-QM products, bank statement, DSCR, those types of things. And if those don't work, now we have a third tier of the safety net.
So something like that, though, let's say, though, you have, let's say, the SHIP program, right? Mm-hmm. And you're getting government funding, but you have a bankruptcy or you have foreclosure. Mm-hmm. Do any of those programs work for somebody like that?
No, so you can't have you can't have anything like derogatory,
even if it's like
events.
six years ago.
Yeah, so if it meets the seasoning period, like for example, if it's a bankruptcy, the seasoning period is usually 2 to 4 years. If it's a foreclosure, it's 7 years.
Right,
typically.
so you wouldn't be at 7 years yet.
So
then,
if it's a foreclosure, then no, you wouldn't be able to qualify for a loan like this. But
okay.
with a
but that's good to know because typically, like sometimes that's why some of these people are in these positions. So.
Yeah. Well, I mean, you would be able to qualify for potentially another type of non-QM loan that they might make. Non-QM products do what's called exceptions.
Right.
So even if they have guidelines and there's something about somebody's financial situation that doesn't meet their guidelines, mm-hmm. they're willing to make exceptions. It's almost like, the way I look at it is like a garage sale. You're like bargaining. You're like, hey, I'll pay slightly higher rate if you make an exception on this guideline.
Right.
Type of thing. Whereas traditional loan products, it's black and white. You can't do that.
Right.
It's either you do or you don't.
Okay.
Yeah.
Well, that's good to know. I mean, some other things that I guess to talk about that happen with these non-QM loans is condos that don't have reserves, mm-hmm. which that's going to change coming up in the future, which definitely is a whole nother show because the whole reserve thing, it's kind of a little nerve-wracking.
It is.
To not know what the future holds. I saw an article about condos saying that 80% of Florida's condos will become they won't be there. And I'm like, how is that even feasible, right?
Yeah.
You're not going to knock down all these buildings, but we did see in Coral Springs, they did knock down a building for, said that it was,
it's going to be interesting to see these condo associations and if they're around, if they just dissolve, and the reality is I think that a lot of these guidelines are being put in place to help, right? But there might be a little pain that these condo associations and unit owners go through in order to get to the light at the end of the tunnel.
But I mean, you're talking about such massive remodels that are needed. And I'm not talking about remodeling the carpet or redoing
You're talking about like structurally.
I'm talking about structural remodels where you're seeing I think it was the Atlantis, I believe, in Pompano. I want to say my friend said his mom got an assessment of like 160, something crazy.
Yeah. And you're talking, just so they're 160,000.
160,000.
Yeah, so everybody understands. Not $160 a month.
No.
Yeah,
and that was another question. Like, so, I had a client was looking at another condo and they were, they said, because they're now getting ready to make that change where now you're going to need the sprinklers in all of the units. And they were saying if it was evenly divided out, they were looking at somewhere like $7,100.
Yeah. I mean, what's going on with the condo associations is definitely going to affect lending. It's definitely going to affect values, right? The harder it is to buy a condo unit, unless you have cash,
right?
Everybody's taking loans out. And
but even cash is still a risk because now you might need more cash.
Absolutely.
What if you're buying this and you've saved? Like, listen, I've bought in things where like I saved all my money, and it's like, what happens when you're like, you have no money left? Like you're in a position.
So the cool thing is that whenever, well, I shouldn't say it's a cool thing, but the smart thing would be, is whenever somebody's purchasing a condo, whether they're financing or paying cash, it's super important that they ask for the condo association's meeting minutes.
Absolutely.
And I know that
for the last 12 months.
Exactly. So that you can at least see, hey, what's been in discussion.
Right. And that will give you
an idea of what's coming up.
Yeah. It's funny how all these years before we never asked that. But let's go to commercial break, and when we come back we'll continue talking about, how these non-QM loans can be put together with these condos, because I think that that's a really good product to buy a condo. So stay tuned and we'll be right back.
Whether you're buying, selling, refinancing, or building your dream home, you have a lot riding on your loan specialist. Max Fisch, a top 1% mortgage loan officer in the nation, will give you a same-day qualifying quote. Max Fisch is committed to providing his customers with mortgage services that exceed their expectations. Ensuring that you make the right choice for you and your family is his ultimate goal. Contact Max Fisch today at 954-729-6933 or max.fisch@nwmcorp.net.
At JK Closing Attorneys, we do all of the same things that a title company does, but with the benefits of being a law office. We can help with residential real estate, short sales, commercial real estate, refinances, 1031 exchanges, and FIRPTA withholding.
Contact JK Closing Attorneys today at 954-332-3111. Again, that is 954-332-3111.
You have been watching Making Money with Laura. For more information, contact Laura Sanders at 954-650-0827 or visit her website at theloracell.com. And now back to the show.
Hi, everyone, and welcome back to Making Money with Laura Sanders, and I am your host, Laura Sanders. We're here today. We're talking with Max Fisch from Nationwide Mortgage, so definitely want to give him a call if you're thinking about buying a home or refinancing a home. And if you're thinking about buying or selling real estate, I'm definitely your girl, because I definitely think about what is most important for you. So we're here talking about non-conforming loans. But before we get into that, I always like for you to let them know, what is the best way to reach out to you?
Oh, always by personal phone, 954-729-6933. That's 954-729-6933.
Okay. And I know we're getting close to Halloween and Thanksgiving, and I think we might have used the word turkey before. Like, I think we did. I think we used chicken for something, but I think turkey was one. If you wanted to get, like a discount on your appraisal, or So I don't know. Just if anybody ever hears chicken or turkey. We've got turkey coming up soon. I mean, I can't believe it's almost the end of the year. It's crazy.
It's nuts. It's nuts.
So going back to condos and these non-QM loans, give us an idea of what that would look like.
Yeah, so condos have to check 50 boxes to qualify for traditional loans. First off, FHA is off the table pretty much.
And let's tell them why.
Yeah, so FHA used to do what's called spot approvals.
Yep.
And so even if an association wasn't FHA approved, you could get one unit FHA approved. The problem is that about a year and a half ago, they changed their guidelines to say that if a condo association requires background checks, then they look at that as being discriminatory. Now, if that's not screaming, we're not lending on condos anymore, I don't know what is.
Yeah, because everybody's
because every
doing
condo
background.
association requires background checks. So FHA is almost off the table. Conventional, there's a lot of different markers that need to be hit. There needs to be certain insurance deductibles. There needs to be certain reserves. There needs to be certain, you can't be in litigation for certain things. And the list goes on and on. Unit owners can't be more than 60 days delinquent on their HOA dues.
Well, that's a percentage of the owners,
yeah, so it's
right?
15% of the unit owners. So there's just a lot of different checks and balances.
Again, saying we don't want to lend on condos.
They're making it tough.
Right.
So pretty much non-QM loans, what they can step in and do is say, I'll give you an example. Okay, the insurance is at actual cash value instead of replacement cost, which is one of the parameters of a conventional loan. They want to make sure that the insurance is at replacement cost.
Okay.
What a non-QM loan would do is say, hey, we're okay with this being at actual cash value. But the catch is you're going to need, instead of 20%, you're going to need 25%. Maybe there's an extra 5% that somebody needs to put down. Or the rate is 1% higher. So that's what I mean by that bargaining aspect of non-QM loans is, okay, we're going to look the other way on this issue, but because of the additional added risk, there's going to be a slightly higher interest rate or slightly higher down payment required.
And are there typically like extra points on these kind of deals, or?
Non-QM loans typically do come with a percent or two charge up front for
People always
various
ask,
interest
how many
rates.
points? How many points?
Yeah,
Like,
yeah. Now, typically, traditional loan types, my office has, we make a rule that any rate that we quote somebody, we're assuming that it's no points being charged.
Okay.
So we're very transparent in that way, but industry-wide, it's not always that way. A lot of people, and that's why individuals
get
and
sucked
buyers
in.
ask that. They say, what points are being charged? Because a lot of banks quote interest rates assuming that people are paying points.
Okay. And I guess just to kind of help our audience understand, and agents, like there's so many new agents, like what typically are the costs on a mortgage?
So really it comes down to three main fees.
Okay.
Underwriting fee. Typically there's some sort of underwriting fee.
And what's the average on that?
The average is probably about $1,000 to $1,200, somewhere within that range.
Okay.
So the underwriting fee is a bank charge. The appraisal, technically a bank charge because the bank makes
But
you
that's
get the
paid
appraisal.
typically in advance.
It's paid in advance to the appraiser. The bank's not making money on appraisals.
Okay.
But
there is a company that's making money now because of
Correct.
changes in laws.
Yeah, but the bank is forcing that fee to be paid, so I'll include
Right.
it in a bank charge. And then there's credit report. So it's important to know that whenever somebody pulls your credit, some companies charge up front for it. But whenever a company's pulling your credit, it costs money to do that.
Yeah.
What we do as a company is we don't make anybody pay for credit reports unless they close. And at closing, the exact amount that it costs us to pull credit, we provide an invoice. That's what we collect. There's no money to be made on that. So those are the three bank charges: underwriting fee, appraisal, and credit report. Everything else, typically, unless you're being charged points, are all third party.
Okay.
So title company, state and county, insurance, those types of things.
So now, explain to our audience, because I think a lot of times, again, we have new agents, which they're still learning,
Yep.
and then we have buyers out there that they don't understand. Like, I always tell my buyers that the average cost of closing costs and prepaids is about 4%. So how can you differentiate for the audience, like what's the difference between closing costs and
Yeah.
a prepaid?
Well, I think for the most part, 4% typically is all encompassing for closing costs and prepaids. That typically makes sense. But really, there's two portions of what people owe at closing. There's true costs, which are fees for services rendered.
That's the closing costs.
Those are considered closing costs, which are, title company is charging a fee to facilitate the title work.
Okay.
The appraiser is charging a fee to do the appraisal. What the prepaids are is when you're prepaying for property related items, meaning homeowners insurance. It's not, homeowners insurance isn't a fee. It's a cost of owning an asset. a
And you
real
get
estate
that
asset.
back when you sell it.
Correct. So homeowners insurance is related to the property. Property taxes is a cost of owning an asset. You're not paying for a service, right? And so that's really how you can differentiate. The homeowners insurance and the property taxes is how you can differentiate. But one note I want to make about closing costs, because I think people and agents and people in the mortgage business, they get too caught up in the percentage of what closing costs typically are, right? Okay, closing costs are typically 3 to 4%. The problem with that is that the lower the value of the home is, the higher the percentage.
Oh, okay.
Because think about it, if somebody's buying a $100,000 condo,
It's still
and
going to be a $350 estoppel.
the appraisal's still going to be $500.
Right.
That's 0.5%.
So yours is only $500. That's cheaper than what I've seen.
It's usually 505. But my point is that's 0.5% right there, and that's just the appraisal.
Right. I see what you're
Right?
saying.
Whereas if it's a $700,000 property, $500 is much lower percentage.
Right.
So typically, as you get lower in price, your closing cost percentage is higher. As you get higher in price, your closing cost percentage is lower.
Right. Okay.
Does that make sense?
No, it totally
Yeah.
makes sense. You
Yeah.
know, I mean, obviously, like you have, when you're buying, you have to pay. You have your title fee if
Yeah.
you're in Broward County, but if you're in Palm Beach County, that's kind of lucky, you're going to get that paid by the seller, so it's going to reduce your costs.
Exactly.
So,
Yep.
yeah. So as a seller in Palm Beach, you're going to have about 1.25% of the sales price.
Yep.
And in Broward, it's going to be about 1% in the sales price. So
And
that
my
totally
understanding
makes sense.
is Miami and Broward are the only two counties in the entire state where the buyer chooses the title company. I think every other county in the entire state of Florida, the seller chooses.
Interesting.
Yeah. Yeah. You can fact check me on that. But I
Yeah.
think I'm right about that.
Well, yeah, you know what? I think there's only one other area too, and I think that's it.
Maybe.
I think that's it, which is weird,
Yeah.
right? I
Yeah.
mean,
It's weird to think about that Miami, that Dade County and Broward County are the only
you know,
two
my luck will
counties.
be when I go to sell my house, it will switch. So I'll be paying title twice.
That would be your luck.
Yes. So, I mean, well, I know that rates have gone down a little bit. So let's talk about that quick because we have a few minutes left.
Yeah.
Rates have gone down. And I know that one of the things I saw all over is people saying, oh, the Fed's cutting,
Yeah, I was
you
gonna
know.
mention that,
So
yeah.
why don't you talk about that?
Yeah, so I've said it a few times on the show, and I say it in all the meetings that I do for different offices, and I think it's so interesting how there's a narrative that the federal interest rate is the mortgage rate. To me, that doesn't make any sense.
Right.
You know, because the federal interest rate was it was higher than mortgage rates were,
Right.
right? And so the federal interest rate is for consumer debt, credit cards, car loans, those types of things.
Okay.
It is
Or CDs? Would
the-
that affect CDs?
Yes, it affects CDs. It affects money markets.
Right. So
Right.
that's what investments are making.
Correct.
Ultimately.
When the Fed lowered their rate a few weeks ago, there was a lot of people putting out false information in the mortgage space saying, hey, mortgage rates dropped. Actually,
I had to hear it all day. They did drop a little bit.
well, what's funny about that is that ever since the Fed announced that they were lowering the rates by 0.5%, every single day since then, except for Friday and today, rates have gone up. Since they announced that they were lowering it 0.5%.
Wait, go back. Say that again. So last week when they announced, which actually has been
Couple
over a
weeks
week.
now,
Yeah,
yeah.
it's been 2 weeks now. Time flies when you're
Yeah,
having fun.
yeah.
So 2 weeks ago when they announced that the Fed was going to be dropping by 1/4 or 0.5%,
Mm-hmm.
right? You're saying what has happened since then? Because rates had already dropped before that happened.
Correct. They dropped weeks ago before that happened, right?
Right.
Every single day since the Fed has dropped the rate by 0.5%, except for Friday and today,
Okay.
rates have gone up.
How much did they go up?
Well, it's small ticks, but my point is,
But yesterday they were down.
no, today they're down. Yesterday they were up.
I thought, yeah, okay. So I thought on Friday I had seen, correct me if I'm wrong, because I'm not the mortgage expert. I just dabble in it. I thought I saw 6.25, and then yesterday I thought I saw 6.125.
No, so on Friday the rates were down. Yesterday
Okay.
they were back up. Today they're back down.
Okay. So what are we at today?
Today you're at like you're at like 6.125 with good credit on conventional.
Okay.
But my point is that you were 5.99 before the Fed made that announcement.
Now would that be unconventional or
Yeah,
okay? Because
unconventional.
FHA is like what 5.65.
So it's gone up about 1/8 since the Fed made their announcement.
Okay.
And the reason for that, guys, is that the Fed is simply taking small steps to bring us back to stability in our economy. And what that shows the mortgage market is that inflation is slowing. And the mortgage market, the bond market, these investors, they don't have their head in the sand. They're paying attention to this stuff.
Right.
And if the Fed is planning on lowering rates, the mortgage market has already reacted to that. So if they come out and say, hey, we're going to lower rates, but maybe not as much as what was expected in the market, or it is as much as what was expected in the market, but they say something that the bond market doesn't like.
Right.
For example, we're going to slowly do this. It might take 2 years. It might take a while. The bond market doesn't like that, right?
Right.
That just means they're being very conservative, and the bond market doesn't like that. So it pulls back and rates go up. That's kind of the dynamic.
Although you're not a financial advisor, would you say that bonds are a good way to go right now, or would you say they're not a good way to go right now?
I think it's the rate is still high enough and the return is still high enough to where it's a super safe investment. I mean, you could make 5% in a money market right now. And the money is,
New tech has, it's where your money is not tied up.
yeah, it's liquid.
Yeah, it's liquid at 5.15.
Yeah, that's how all these money markets are right now.
So it's like, the only thing is that it's like, yeah, you could lock in a CD and be guaranteed 5 months,
Yeah.
6 months, 8 months, right? You know, because I remember when rates were like, CD rates were like 8, 8.25, 9, and it's like, I mean, then they went to like negative.
Yeah,
Like,
yeah.
you pay us to put your money.
Yeah.
I'm just kidding. No, they were like 0, 0, 0, something
Yeah.
crazy. When you know, so that's the thing. You know, when rates on mortgages are low, that's affecting your other money. So it's like, you know, I just made a great point to myself, right? Unless all you have is your house, right?
Yeah, it's all intertwined.
Right. So
Yeah.
like when interest rates are down, investments are really down.
Yeah.
And when interest rates are up, investment rates are up.
It's
So
because you know what drives mortgage rates down? A struggling economy.
Right. So honestly, like when people are like, oh, I shouldn't buy right now because rates are so high. Like, this is normal.
Yep.
So the moral of the story is that if you like a house and you can afford it, you should buy it.
That's the moral. It's always the moral of our
That's
stories
right.
here.
So,
So, yep, that's the gist of the rate market.
all right. So let our audience know one more time.
One more time, you guys can always reach me by phone or text at 954-729-6933. It's 954-729-6933.
Or if you're thinking about buying and selling a home and you want the best agent possible, definitely give me a call. My name's Laura Sanders with RE/MAX Direct. Only been there for like 24 years. 954-650-0827. Thanks and make it a great night.